Here's the question, Patrick. Are housing prices going to go higher or are they going to crash?
Well, that's a great question. I think the reality of it is they are absolutely going to go higher, but it's going to be different than you think it is. It's actually because inflation is coming down. How's that?
Also, unemployment is also increasing. And the question is the Bank of Canada going to stay ahead of this thing or are they going to overreact? You know my opinions, but let's dive in and find out in this episode.
Get it done.
Ladies and gentlemen, episode 50 of Rein It In. Thank you so much for watching. Today we got a great show lined up for you. We're talking about the money supply. We got graphs, we got charts. We're talking about the government bond yields. We're talking about employment. We're talking about CPI. We're talking about China and how the world is falling. Or is it? It's going to be good. You're going to love the episode. So strap in, get ready. Patrick, let's go.
Let's go. Hey folks, always a gentle reminder, make sure you like, subscribe, comment, get those algorithms fired up. We like you.
All right, Patrick, let's get talking about housing prices. You know what? I really feel right now there's like this divide. Let's call it the great chasm, which is some people are thinking prices are going to go higher in real estate. Some people think it's going to crash. No one is really thinking it's going to stay exactly where it is. It seems to be some people think it's going to go higher. Some people think it's going to crash. Where do you stand and why? I know I got my opinions.
Well, I love that great chasm. I mean, I think that's what you said. And it's true. There is the great divide of what housing is going to do. And much of it is driven by market sentiment. In other words, let's go back to what we talk about all the time. If we look at data, we're going to have a different view of the world than if we're looking at it emotionally. If we're a home buyer, we're going to look at it way different than if we are an investor. So here's the point. When we look at where housing is going, and let's have a window, because right now everybody's talking about if housing is going to do something tomorrow. It's not. We're going to have to play the long game. So if we look 10 years down the road, even if we look 5 years down the road, housing will definitely go higher, in my opinion. And one of the reasons is, believe it or not, as much as we talk about inflation going up, one of the reasons it's going to go down, or one of the reasons, that housing is going to go up is because inflation is coming down below the 2% mark. That's the fear right now. And that's going to create a whole chain of events that is going to drive our housing prices again. So, if you want to talk about that, let me know.
Well, I think, Patrick, we should really dive into this because you prepared some fantastic kind of slides on money supply. And I think this is where, everyone talks about supply and demand in the real estate market, right? Which is like, the supply and demand of the market economics really drives where prices is going. Now, there's a pretty big influencer, which is interest rates, but that comes down. Interest rates just one part of the money supply. We've really never dug into this. I think you and I, we talk about this geeky stuff off camera. We're having lunch or whatever. But I think it's time we have this conversation on screen because it will really give people an idea of how money supply works and how it impacts the real estate market, because we're just coming out of a really tightening, what's called a tightening cycle, where the Bank of Canada is tightening. They're constricting the money supply from many different angles. You'll see that soon. And when that happens, there's just less money out there for those hard assets like real estate, where you need, no one's buying real estate like with all cash. You need the debt to accelerate the real estate market. Without the debt, the market really stalls. That's why they do that to the money supply. So let's kind of dive into this, Patrick.
Well, money supply, as you can see by this particular chart, and we look at housing prices, and they actually correlate perfectly with the money supply that's coming into the market. So let's break this down a little bit. When interest rates go down, people borrow more money. Well, we know that. We see that in the housing market, and everybody puts one and one together to get two, which is, okay, interest rates down, housing prices go up. But there's more to that. There's also the understanding that the government of Canada also needs money. We're operating in a deficit. We're trying to grow an economy. Whether we agree with that politically or not is a different conversation. So what happens is they sell the Bank of Canada government bonds, and then ultimately that puts liquidity into the market, because then the government of Canada does all the things that they do with that money. Then the other side of it is Bank of Canada goes, oh, okay, there's other things that are happening in this marketplace. And one of them is that lending is too tight. So beyond interest rates, JG, the Bank of Canada considers, and this is working with OSFI, so that's a different conversation. But what's happened up until now, back to restricting money supply, OSFI, for example, said to the bank, you need to increase reserves. And so there's a risk of a crash, there's a risk of people defaulting on their mortgages given the high interest rates. And so OSFI said, okay, all central banks, you got to tighten reserves. They said, let's just talk about Canada. So ultimately, 3 times the Bank of Canada slash OSFI has forced the banks to tighten up their reserves. In other words, increase reserves, which means they have less money to lend. So when we don't lend money into the market, and not just in housing, by the way, but even businesses, they're not borrowing. We know that. People aren't borrowing. We see that. So what happens is liquidity in the market tightens up. So when M1, when they open it up again and go back into a quantitative easing. So in other words, they're going to open up the market so more money floods in, then people have access to it, sentiment shifts because everybody's feeling like, oh, hey, we got this. Then ultimately that goes into the market, which goes into the housing market. Now, following so far? Am I making sense so far, JG?
You're making sense so far. I just want to iterate one thing, which is you're right that money supply obviously impacts business for sure, especially big business, but it impacts small business too, a little to the lesser extent. But the point is it impacts business, but it has a real massive impact on real estate because, I mean, how much of the real estate market is debt? Without debt, the real estate market doesn't roll. Like, let's be clear. Now, the business market, like I could operate my business, you could operate your business without debt. Many businesses that are established can operate without debt. Whether they choose to or not, that's a separate question. But nobody can operate real estate, or very few people can operate real estate without debt. That market just grinds to a halt when money supply gets constricted. And that's what's been happening, Patrick. And I think you've illustrated that really well.
Well, there's a couple of things that are also going on in behind the scenes. So we talk about this 2% inflation mark. Now, JG, you over the past couple of years have talked about the environment becoming deflationary. In other words, I've talked a lot about the inflationary side of it. You and I have debated that subject, but ultimately, some aspects of our current economy are being deflationary. In other words, they're going under 2%. Bad news when it comes to what the Bank of Canada wants to happen. We need that 2% inflation mark. And there's already conversations about going, well, when we take the increased interest rates out of that equation, when we take the shelter costs out of that equation, we're below 2%. Well, that also sets off another alarm bell, which going, holy cow, things are slowing down too much. We've overcorrected. Oh, surprise to no one. But ultimately now they say, okay, now we have to see the economy slowing down. We see unemployment going up. We see inflation getting not only under control, actually coming down a little bit. Now, what do they have to do? They have to open up again. They have to bring interest rates down, which they will on the, and I want to be clear about this, they will on the overnight rate, which affects the variable rate mortgages, which affects us as real estate investors. Good. But ultimately, they have to, again, get money back into the market so that, number one, businesses do borrow. Again, the housing market, which is a big part of our economy, starts to get fired up again. And so we're going to go through this transition. Now, this isn't going to happen overnight. It's going to take probably at least a couple of years. But over that period of time, you're going to see housing start to increase. I don't think we're going to see a big drop. I mean, let's not compare it to the peak of 2022, 2023. Let's not go down that path. It's come off, in particularly in specific property types, the condo market in Toronto, in GTA, in Vancouver. Let's just be clear about that part of it. Let's take that off the table. And then we are going to see more money coming into the market. We're going to see real estate prices start to go up.
This chart here, Patrick, talks about inflation. It really shows, where the inflation is. I want to draw a couple interesting, and you and I have been saying this for some time, but look at the line. It's the light blue line, the CPI excluding shelter costs. That means you're excluding the interest rate effect on mortgages, for example. You're taking that out of inflation. Check that out, Patrick. It was down to the 2% mark in May of 2023. And now it's going to be May very soon, May of 2025. That's 2 years ago. And we've been on this crazy tightening cycle, but the point there is that, definitely inflation is getting to where they want. They always do the same thing. They always do too little, too early and then too much too late, which means they overcorrect. It's very difficult. I'm not saying they're doing it wrong. Well, I am saying they're doing it wrong, but I guess I'm saying I couldn't do it much better because you're handling a pretty big machine, Patrick, and it's hard to kind of land it perfectly. But that being said, what is going to get very, very interesting with regards to deflation is the way they're going to combat, and that's what you're saying, the way they're going to combat deflation is to make money, is to increase the money supply, loosening the tightening cycle, essentially making quantitative easing plays a role in that. Interest rates play a role in that. These other rules will play a role in that. And they got to get money back into the market. And that is how they're going to help stop the deflationary pressures. That's the only tool they have, Patrick, frankly. That's the only tool they have. So they're going to use that tool as much as humanly possible from their perspective. Is it going to have the desired effect? I don't know. We're going to find out because we are, as you and I have talked about before, there is a convergence happening in technology, and technology is very deflationary. So we don't know if it's going to have a full effect of getting them to 2%, or we might be on a deflationary pattern for some type, and that would be really tough because I got to say, none of us, even in your case, Patrick, you've been at this for 40 plus years. You haven't been through a deflationary period either. Most of us living today have never been on a deflationary, extended deflationary pattern. And I don't know what the hell that's going to do to the market. That's for sure.
Well, not to this degree, but to your point, we actually have been. I mean, when we look at the cost of things over the years, we've seen a lot, especially when it comes to technology. We see a lot of prices come down. The bigger issue is that we are in a epic global, by the way, not just Canada, debt cycle. So in other words, everything is being driven by debt. When we look at the US and their trillions of dollars of debt, they have no way to service that debt. They are in fact borrowing money to make the interest payment on the debt. And so Canada's no better. I mean, there's marginally better, and there's all sorts of debate around Canada and they're safer and blah, blah, blah. Point is I think we're at 1.2 trillion of debt in a population of 41 million people. And we're, bringing more and more immigrants into this country. There isn't enough jobs to go around. I mean, Canada, when we look at what's going on economically, and we look into the future, we've got some big headwinds. That's all to say this, that deflationary part of the cycle is really important to understand, because that also doesn't work for the debt cycle that our government is facing. So we're going to see on the other side of it, we're going to see some inflationary impact, which is also to say that we're going to see increase in taxes. So these are all things that are happening. And so there isn't any, we want to think linear, and we want to think, okay, A plus B equals C, and that'll result in D and all the rest of it. But it's not that simple. The point of it is that I want to shine a light on today in this particular conversation is that when we look at how economies go, and when we look at debt cycles, when we look at what the government has to do to re-stimulate an economy, because make no mistake, I mean, Canada is slowing down. And I say that, and we qualify our western provinces as in Alberta, as in Saskatchewan, Manitoba, but that doesn't make up enough of the population. So ultimately, we look at what's happening in Ontario. Ontario is getting its ass handed to it in many aspects of what's happening, and not the least of which, by the way, is the fact that we are not increasing productivity. And we've talked about that to nauseum, and we see that in the chart where we look at what's happening from a business, small, medium enterprises, SMEs, and they're just not growing. Our government sector is going off the charts, non-productive. It's a cost. Taxes pay for it, but we're not being productive. So let's go back to something you said a little bit earlier, which is, as much as we depend on the real estate market, we need to get our small, medium enterprise businesses going. They do need to borrow money to expand, especially in those manufacturing situations, those small manufacturing, small production businesses. They need to borrow money, but they're not borrowing money, so they're not growing, and they're not creating the jobs that we need to accommodate the amount of immigration we've got coming in. It's a mess, but let's put it this way, JG. It goes back to what I said before. The Bank of Canada, I think in early 2025, and I'm just guessing, it's just a freaking guess, but given the way the economy is going, short-term interest rates will come down. We can talk about the bond yield, and I want to talk about that in a minute. But ultimately, we got to get capital back into the market in order for us to continue to grow.
What's the Patrick prediction? You know, they're going to be coming out with their rate announcement in like, what is it, like a week, 10 days? What is just about 2 weeks roughly? What is the Patrick prediction? Give it to me right now. What are they doing? They're doing a double cut. I'm calling a double cut right here, which means a 50% basis point cut. What are you thinking, Piff?
I don't know. I really don't know. It's anybody's guess. Throw something up against the wall. I don't disagree with you, but I wouldn't be surprised if they go quarter. I wouldn't be surprised by that, but we'll see what happens.
But you're not. You're definitely saying they're going to cut. You're not saying they're going to stay.
They won't hold. There's no, oh man, I'd be shocked if they hold. They're going to go, I think, bare minimum.
You've been shocked before. That's all I got to say.
I think I'm wrong every freaking time, actually. Anyways, the point is that I think they definitely have to come down when we look at what's going on. I mean, they've got to get the market liquid again. And I think part of what we're operating on top of is the fact is we are lacking liquidity. And as we go forward, just on the mortgage side of the equation, JG, I mean, think about how many mortgages are renewing in 2025. We know that I think it's like 60% or something that of the mortgages out there are going to be renewing. So they have to do something to bring those rates down, or I think the consequences are going to be quite severe economically. Because ultimately Canada depends, like many countries, it depends a lot on its housing market. And so I don't think they have a choice.
Double cut. I'm calling double cut. I would love to see a double cut. That's what I'm calling it, a double cut, which means double cut this one in October and then another double cut before the end of the year. That would really spur things up. That would be very exciting, Patrick.
Well, I think there's some pundits in the world that are going, we'll never see rates under 3% again. We'll be down into that 3.25%, and I don't disagree with that. I think
are those the same? Are those the same pundits that were saying during COVID that like rates would never go above 2% ever again, and they would just be like forever? Probably the same pundits, I imagine.
Same pundits.
I wish I was a pundit. You get paid to be wrong. I mean, it sounds pretty cool.
Yeah. Well, that's what we know about economists. Hey, speaking of economists, I was in Calgary and I was speaking at a WellShare event, and I got to speak alongside Todd Hirsch, who is a very well-known economist in Alberta, worked for Alberta Treasury Branch for many years. And that was fun. It was good to see him again. And it was fun to, I'm just an armchair economist, so what the hell do I know? But I did pretty good. And as a matter of fact, Todd commented afterwards and suggested that my slides were actually maybe even a little better than his, which I thought was quite good of him.
That's fantastic. So just to recap on employment before we move on, Patrick. So this chart here indicates that really we're creating fewer entrepreneurs and we're just creating a bigger and bigger government here. And you can see since since COVID, since 2020, I mean, entrepreneurs have flatlined, gone down a little bit. Definitely not a good trajectory, and government's just gone parabolic on this chart here. As you can see, it's crazy.
It is really crazy. And sadly, that's the situation that we're facing. So some of it, when we're talking about and making the changes, we're looking at the psychology of our current government. We're looking at the psychology of the Bank of Canada. When I say psychology, we just have to look at their track record and their propensity to do what they do. So then you kind of work backwards from what they have a track record of doing. And then you start to realize that at the end of the day, rates are going to have to come down. They've made the mistakes that they've made, and we have to put in the correction. Again, we're armchair economists. We're genius in our hindsight, and we can. But you and I have been talking about this for 4 years, so different versions of it. The narrative really hasn't changed. Our timing's been off.
Now, if you dig into the employment there, you can see healthcare and social assistance has gone way up in terms of monthly change in payroll employment. Educational services up, public administration is up, and then the two that are down are construction and manufacturing. And construction, Patrick, as the real estate market picks back up, there is no doubt construction is going to pick back up. I have no doubt about that. I think by the spring to summer of next year, this is going to be on a much different trajectory. That's my thoughts.
I don't think it'll happen that fast, but I do agree that it's going to change. But the point goes back to what we said before. These are all lagging. So this is not even really starting to show up in the news and in the headlines. It's only starting to, and we're only starting to hear conversations about how soft the construction industry is getting, particularly in Ontario and in British Columbia and Vancouver, Toronto specifically, if we want to really get into the details of it. Whereas in Alberta, we're actually seeing some increase in the construction because they are building a lot more housing in Alberta, which speaks to just the difference between municipal government and even provincial government and their willingness to get stuff done versus what's happened in Vancouver and Toronto over the years, which is just the kind of meltdown or the lockup, if you will, of zoning restrictions and taxes and all the things that go into what drive that particular market. So all to say is that in some sectors, in some provinces, we're going to not see the damage that is being created right now in Toronto / the GTA and Vancouver.
Now, Patrick, what's the scoop? By the way, I was in Alberta last week, and it was great. I picked up, like, I saw a newspaper laying around, so I was like, I want to see what people are writing about in Alberta. So I picked up the newspaper. I saw Danielle Smith was suing the Trudeau government, and I think the deadline was like, was it late last week? I believe for her demands to be met. I mean, I don't know. I don't follow it that closely. Are you following this or?
No, I don't. Listen, that's just politics, and I'm not paying attention to it because there's nothing I can do about that. I want to stay ahead of what is going on when it comes to housing and economy. That's really where my focus is, and that's what I pay attention to.
If you want to stay ahead, then let's get back to this M1 money supply, because I do think, in this chart that you created, I think is phenomenal, because it shows the absolute correlation between housing and money supply. When they loosen up money supply and it goes up, housing quickly follows. And this is really fascinating, Patrick. And you can see, like, it's 1-to-1. I mean, it's incredible how tied this is. So with this, maybe take us through this other diagram of how you see the following kind of, lending conditions, and overall how the central banks, what they're going to do, and how it's going to impact the banking system, and then how it's going to flow through to the real estate market.
Okay, so let me walk you through this chart and see if we can kind of make it about what I want to expand on in this conversation. Actually, is that we focus on interest rates. Often that's the biggest conversation, but what we don't talk about is the quantitative easing component of it all, which is to say money coming in. It's about liquidity. So when liquidity dries up, what happens is that there's not enough money going out into the economy. And when we're talking about housing, for example, or when we're talking about economies in general, as things are starting to slow down, keep in mind, we have to link to that 2% inflation rate, JG. So important to understand that is the commitment of central banks. And let's just talk about Bank of Canada, 2%, 2%. They beat that drum to death, and they actually work to keep it at 2%, even though we know so many components of our CPI are above 2%, food as being one example of that. But Bank of Canada puts money into the market as they start to see, as they start to see an economy slowing down. So they use open market operations, increased liquidity, which is that M1, more lending and borrowing. It got to be about that. And then that increases the demand for housing as interest rates come down, as the economy improves because money's flooding into the market, businesses are borrowing, they're starting to hire again because they've got operations growing. That would be the intention. And then ultimately we see rising house prices. So as much as we're focused on interest rates, and they are a big component of it, it's not just that. So when we talk about M1 money supply, we have to look at quantitative easing. Well, what does that mean? One of the components of that, for example, is back to what I started with, which is OSFI saying, okay, there's a huge risk of default in mortgages and default in businesses. Banks, you need to increase your reserve fund. They did that 3 times for sure, maybe 4 times, where they said to all banks, you need to make sure you have reserves to cover any losses that show up on defaults. Well, now what they do is they start loosening that and say, banks, you don't need to hold on to that money. And so that allows the bank to lend more money. That's what we need to do.
And just to dig into that, Patrick, because the way this actually works is say a bank, just so in case people don't know, because there's people watching this show, they've never heard of this before. So let's just say a bank has $1 in on their balance sheet, they're going to be allowed back in the day without these reserves. By the way, previous to the 2008 Great Financial Recession, they didn't have reserve requirements. They could just do whatever they want pretty much. The lending conditions were the reserve requirements were not nearly as tight. So they used to lend that dollar out 90, call it 97 times. It was like a crazy amount of times, Patrick. Well, is since 2008, there's been reserve requirements that says you can't lend it out 97 times. You can only lend it out, say, 35 times. And what you're saying, Patrick, is when they increase the reserve requirements, they decrease the number of times that dollar could be lent out. And what's happening is they've done that 3 times recently. And now where's it going to go going forward? That's the question is are they going to make it easier? Are they going to lower those reserve requirements and go back from 30 to 35 to 40 to 45? That's what we're going to find out.
So yes, so lending that dollar out 97 times, no. They lent that dollar out 110 times. That's the point, is they continue to lend money. That's the biggest thing that we've got going on right now. And that's where there's a huge risk on a global scale. And that is the fact that we are in this huge debt cycle, which is what we just talked about a little bit before. At the end of the day, this economy is slowing down. They're going to have no choice but to start to inject capital back into the market to increase liquidity to get this economy going again. So we have to consider that. Let's go back to real estate. So first off, there's always a lag in all of this. So we're going to feel some pain into 2025 for sure. We're going to see unemployment go up, and they'll start to make these corrections, but then that's going to take time. So over the next couple of years, what we're going to see is a little bit more pain. This is my opinion, by the way, my armchair economist hat that I'm putting on. And ultimately, we're going to see more pain economically. The bank is already going to have put corrections in. Everybody's going to be optimistic about what's going on. But over the next couple of years, you're going to see continued opportunity to invest in real estate if you remain savvy, remain committed, have a long-term view of it, because real estate will in fact increase, and it's going to increase for a whole host of reasons, not the least of which is to keep the economy going.
That's a good point, Patrick. I think you said something interesting a while ago, and you said, our economy, as well as many other, first world economies, we really rely on real estate, and that's important. We rely on that housing sector. It's a huge part of people's wealth, and if there's any market they keep their very close eyes on and they make sure it doesn't go too low, is the real estate market. In my opinion, Patrick, this is really, really important. Listen, like, I forget the percentages, but what's the percentage of people's wealth that is in the real estate market in Canada? It's a huge number. It's by far the number one thing, like by a landslide. So they want to make sure they're going to make sure that that has a floor to it. And the reason for that is because, as you just talked about, with these reserve requirements and the fact that for every dollar that they have, they're lending it out 110 times. That creates a very fickle environment. And if this house collapses, it would get really, really crazy. That's why they engage in things like quantitative easing to make sure it doesn't collapse. Is it right? Is it wrong? That's a debate for another day, but that's the reality of what happens.
That is the reality of what's happening. And I go back to what we've talked about. Let's understand a couple of fundamental things, which is that when liquidity floods into the market, hard assets continue to go up. And by the way, hard assets, I mean, it could be Rolex watches. I mean, it could be literally that. We know precious metals, we talk about Bitcoin, but real estate ultimately is that hard asset. And there's another side of this, which is the politics of it, JG, and we've talked about it before. Canada, baby boomers are now, like, our wealth is in, many boomers' wealth is in real estate, primarily their homes. So you have to consider that politically, if real estate prices come off too far, whoever is in power, from a government point of view, is going to get their asses handed to them, because there's no freaking way that boomers want real estate prices to come down. Number one, that would be devastating to whatever government happens to be leading the charge at that point. So government, in alignment with the Bank of Canada, are going to want to keep those prices inflated. And think about something else, JG. Even municipally, do you want real estate prices to come down? What happens? How do we collect tax? I know this gets a little too deep, and maybe
based on the values of real estate.
Guess what? their municipal taxes are based on the values of real estate. So what are they going to, they have to consider that. So the point of it all is that this is when you look into the future of real estate, will you have some blips along the way in certain property types? 100%. And even in some regional markets, we know that they're going to change. But the long-term game, if we're real estate investors, real estate is a hard asset to own. Personally, I think that the bigger risk is not putting your capital to work. So in other words, if you got money in the bank, you are at huge risk of losing the real value of that currency, of all of our currencies. And that's a different conversation. So my point is that when we look at what's got to happen, and we haven't even talked about China yet, we haven't even talked about bond yields. And I mean, that's also another factor that we have to put in. All of it is a kind of a supporting thesis, if you will, of why real estate prices in Canada will continue to go up. And then when we get into property types, we got to talk about single family detached or semi-detached.
We will talk about that in just a sec, Patrick, but I just got a quick question for you, which is, you talked about when money supply loosens up, hard assets typically accelerate. My question is, do you consider turkeys a hard asset? Because it sounds like you recently invested in a hard asset called a turkey.
Well, I froze mine, so it is a hard asset because I'm not eating that freaking $87 turkey. I'm going to freeze it next year, or in a few months from now, it'll probably be worth $100. So I'll have that gain. Maybe I'll put it on Marketplace.
Gosh, listen, ladies and gentlemen, if you are investing in turkeys and freezing them, I'd love to hear about it. Put it in the comments below. And if you want to laugh at Patrick, please do so. Put it in the comments below. All right, Patrick, let's talk bond yields, because, I was really pumped a couple weeks ago. Bond yields were down to 2.7%. And as you can see, from like July to September, like end of September, it was looking good. And now we've had this pretty quick spike from 2.7 back up over 3%. I want to know your take on why this has happened, but also, just so everybody knows, this is how fixed rate mortgages are priced, is based on the 5-year government bond. So if this is going up, you can expect higher rates into the future on 5-year fixed rates. And if this is going down, well, good news is that those rates are coming down. And I was seeing, Patrick, I had lunch with some mortgage brokers last week, and I was seeing mortgages 4.5, 4.8, 4.7. I was like, yes, things are making sense again. But I'm afraid things are not going to make sense in like a month if this keeps up.
Well, I think there's a couple things, right? Which, dude, I turned down 4.2 fixed, 2-year, I think it was, maybe it been 3. 4.2 fixed on a mortgage. I stuck with variable at 6.4, I think. I don't remember exactly, because I think, like you, I thought, I think fixed rates are going to come down.
Is that a good move, though? 4.2 is a pretty damn good rate, bud. I declined, I think it was 4.7 fixed. But anyways.
I think there's a couple things around it. So 4.2, I think, was the rate. And I might be wrong about that. My decision was to go with a variable because I thought fixed rates would come down some more. Like you, I was pretty optimistic about it. And I was thinking, well, a lot of bond yield is being driven by the fact that there is not a lot of optimism in the future of the economy. So then we start to see bond yields drop. But here's the thing, because it foreshadows where people think the economy is going. What I didn't anticipate, in hindsight, I did, but I looked at it and the realization, I went, why the heck are these things spiking again? Well, ultimately, things are spiking for a couple of reasons. And that is the unrest or the uncertainty of what's going on in the world. So when we look at what's happening, Israel and Iran are two big issues, Russia, China, big issues. But here's something that people weren't thinking about, and that was, or I wasn't necessarily thinking about it, I knew it was soft, but I didn't realize just how much China has slowed down. Numbers are coming out. You can't really ever trust the numbers, but ultimately what numbers are coming out is their GDP is like, didn't hit 5%, which is like rare for China. So things are slowing down. Their real estate market is literally crashing. Then you have the threat of what's happening in the Middle East and the fact that, oh, guess what? We may in fact lob one into the Middle East, which would then have a huge effect on oil prices. I've been talking about oil prices spiking for quite some time. I still believe that we're going to see that increase, although that still remains a debatable point. My point of all of this is what I did was I kind of correlated oil prices with bond yields, and I'm going, you know something, there's a pretty good correlation as bond yields really kind of align with what's happening with oil prices. So I overlaid a couple of charts, did a little magic, and I look at it and I go, I don't know what your thoughts are, but I see that as oil prices go up, so do bond yields. I don't know if it's a proven science, but I couldn't help but notice that. So, all to say this, I believe 100% that variable rates are going to come down. I think the Bank of Canada has no choice but to start to work into that M1 money supply issue again, which includes lowering the overnight rate, which will mean variable rates come down. That's why I hedged on that. I'm not so confident anymore on bond yields and fixed rates. I think now, as I'm looking at this and as we're seeing what's happening and what's unfolding globally with wars and oil prices and all the things that are happening there, I go, we may actually see a tick up in 5-year fixed rates. We could literally see that this over the next couple of weeks, like right now, going forward, we could see a tick up given that bond yields are starting to kind of stay in that higher range. That's my thought on it.
Yeah, it's interesting, Patrick. I think there's one thing we talked about this all, gosh, it must have been about a year ago. And I think it's worth repeating right now, which is one of the things that is certain and for sure is uncertainty for the next while. And uncertainty creates variations like this. Now, uncertainty also creates a little bit of market chaos. And by the way, there's lots of great opportunities in the market chaos. So that's important for investors to realize. But I think it, and this comes back to what you and I've been saying about people sitting on the sidelines. And I was at a speaking engagement just last week on Thursday. I flew back from Calgary on Wednesday. So I went to a speaking engagement on Thursday on a real estate tech conference. And, I was talking to the people and they were asking me great questions, which led me to, in my speech, say that, the real estate market isn't broken. And I think that a lot of people have kind of, you talk about how some people are just kind of not interested in real estate market right now because, I don't know, it's a little bit difficult, more difficult than usual to make money. I'm not sure what their deal is, but the fact is the real estate market is not broken.
How do you do that? What the hell is going on?
Now, as you and I always say, Patrick, there's always a way. There's always a good tactic for the right market. But if you pick the wrong tactic in the wrong market at the wrong time, that can be disastrous. But that doesn't mean the real estate market is broken. That means you chose the wrong tactic in the wrong market at the wrong time. That doesn't mean the market is broken. And I think people need to be reminded that when you invest over the long period of time, real estate is very, very well, but you do have to make tactical decisions that make sense. And that isn't always easy.
Okay, so you make some really great points. I want to expand on it a little bit, JG, and that is this. When we just look at what we've talked about in this particular show with money supply, the fact that interest rates are going to come down, when we look and we see the correlation between money supply and increasing real estate, to your point, real estate's not broken. It's following the pattern that it has always followed. So we have to be really aware of that. So first and foremost, we talk about it. We've said it hundreds of times, which is there is no bad economy for real estate. There's just the wrong tactic or strategy within that economy. So here's my point. If we go back to what I said earlier, which is real estate / hard assets are going to go up. You, for example, with Visture and all that you do, you're in the trenches every day. You're grinding it out. We see people sitting on the sidelines, and those are the kind of, we'll call them mom and pop investors who are going, it's too hard to get money. I don't want to have to go to the bank and jump through all these hoops. Given affordability, I can't come up with a down payment. So does that mean you get right out of the real estate market? And the reason I'm sharing this point is because I spoke in Calgary and as well. And, I did a well share event who happens to be a trusted partner. It could be Ferris Capital, it could be Equiton. My point is those are all private REITs. In other words, you don't even have to go to the bank. If you can understand and buy into the thesis that real estate prices go up, then all you're really working at doing is getting your capital out of the bank into hard assets. And if real estate's part of your portfolio, that's a great hard asset to get into. And so you can do that vis-a-vis a private REIT. And I say private REIT for a specific reason. Number one, and primary reason is that you're going to probably meet the CEO, the COO, the CFO. You're going to meet the whole team. You're going to see the model. You're going to have conversations with them. You actually have input, which is different than, let's say, going on the stock market and investing in a REIT on the stock market. That's just you're buying a stock. There's no communication. My point is that those private REITs are an excellent way to get in the market. You can get in for 5, 10, 25 grand, way different than coming up with $150,000 down payment to buy and do a do-it-yourself, for example, single-family dwelling / duplex, triplex, that kind of thing. So my point is that real estate is still a viable. You just have to change the strategy to get into the market, get the hell off the sidelines, and start taking advantage of what's going to come down the road.
Let's dig into this, Patrick, a little bit and double click on this concept of tactic, and specifically, let's call it asset class, which is what you purchase is very important. You know, people right now, everything that's commanding the headlines is condos. You know, condos are, it's not working. And you and I called that years ago, saying it's going to be a mess. When the condo market, it's going to be a mess. It is a mess right now. But everyone thinks real estate is broken because of the condo market. That is not true, Patrick. So let's make a prediction into the future. You've been talking about for some time. I've had my entire investment thesis based on this since 2012, which is single family houses. Single family, that asset class is essentially, number one, it performs extremely well, especially when you combine it with an accessory suite, especially when you combine it with a coach home or an accessory, an ADU in the backyard, for an example. That turns a single family into an absolute game changer. And I have a very specific reason why right now is a great time to be getting in on that. But your point, Patrick, is they're just not building any more of these things. I mean, look at this chart on housing starts. It's crazy.
Well, let's be very specific about when we talk about single family. Single family is any unit, in this case, detached or semi-detached, that is not qualify for a commercial mortgage. In other words, 4 units, 5 units or less. But it's not, when we say single family, we're not talking about a bungalow that you're going to live in and it's going to have a rumpus room downstairs or whatever they call it, family room these days. My point is it's actually got a secondary suite bare minimum. And often it's going to have, like to your point, maybe a coach home or some other ADU on it. So let's qualify single family. That's what we're talking about, where you can't go in and get a commercial mortgage on that particular property. Single family, they're just not building more of it. They're not building enough of it. The qualifier in that right now is maybe Alberta. Calgary seems to be quite aggressive in that mode, but still far short of the requirements that they're going to need, which is all to say this, is that real estate will, even if your only thesis is supply and demand, we don't have enough supply to meet demand, real estate prices will go up. If that's your only thesis, you're going to win, because that is in fact the case when it comes to single family detached.
Well, and let me just accent this point a little bit, because right now, right, because of the chaos in the condo market and because of supply and demand and because of money supply, like you've learned now in this episode, because of all these things, I think this is one of the best opportunities in real estate right now. It's exactly in this asset class, Patrick. And the reason for that is because the entry price is better than it's been in a while, which is good. I mean, if depending on the market, of course, this is all very regional dependent, but your entry price is very, very good in many markets. The markets I operate in anyways, which is everywhere from Peterborough to Lindsay, Aurelia, Barrie, Oshawa, entry point price is very, very good. If you're going to do an accessory suite and if you're going to do an ADU, trades right now are plentiful. Well, plentiful is a big word. I wouldn't say plentiful, but I would say they're available. And 2 years ago, they weren't even available. They weren't even calling you back. So the price of trades is better than it's been in years. Interest rates are coming down. We know the trajectory of interest rates over the course of the next couple of years is going to be lower. Is it going to get as low as you want? Maybe, maybe not. But the point is we know it's heading lower. And the fourth thing, Patrick, is values for these. And I this is the game I play, so I know it intimately. The values of these properties is they are keeping and maintaining their value. And we know that going forward, if money supply and if you understand what we just talked about, values will start to go up. This, to me, Patrick, is the perfect storm for this asset class right here, right now, October 2024. You heard it here first.
Or maybe second or third. But the point, I think you make a great point. I want to just qualify one thing. It's going to be a little rocky and a little uncertain. It's going to definitely be uncertain, and you're going to see that. But when we look, and let's just give ourselves a 7 to 10 year window, and if we look at that 7 to 10 year time frame, you are going to win the game. And it would be shocking to not see it go that way. It's going to be a much bigger global event for things to stall or come off too far. But again, even with a global event, what are they going to do? Quantitative easing. They're coming back. They will be forced to come back to that. It's the only tool that they've got left to keep this economy alive and keep it going. And I'm not just talking about in Canada, I'm talking on a global scale. And that's what I think we're going to start to see happen. That's my kind of view of the world right now.
All right, Patrick, last thing to touch on. What's going on in China? You're saying that the markets are slowing down over there. It seems like they're making some tax moves. Hearing lots about China these days, but what do you got for us?
Well, I mean, it's, just at a high level, and we have to kind of look and see what's happening in China. And the reality of China is that economy is really starting to, by China standards, implode. And that's been going on. And this information is just starting to come out. This particular headline is really shining a light on the fact that in China, their real estate market has in fact imploded. I mean, there was lots of things around that. We don't need to get into the details of it, but ultimately now they're going, okay, well, all of this money is flowing outside the country, and they're going, that'll be enough of that. So the consideration is to stop the outflow of money into other real estate markets outside of China and keep that money in China, which is what they need. This goes back to what we just talked about, liquidity. So ultimately what China is doing is saying, we need that money. And this goes back to what we talked about, which is liquidity within their market. They want to keep their capital or their investor capital within China, not let that money go outside of Canada. That would in fact have an impact perhaps on the Vancouver market primarily, not to say that it doesn't also impact Toronto, but historically that's where we see that offshore money coming from, is from China into the Vancouver market. Seems to be the popular place to park capital. China's actually going, that'll be enough of that. We're going to slow that mess down, keep that money in China because we need it to support our own economy. We'll see where that all goes.
Oh, China is going to be in the heart of much of it, I think, in the next little while. It's going to be interesting.
It's going to be very, very interesting. When we look at what's going on in a global, macro, geopolitical, gosh, FUD, fear, uncertainty, doubt. It's well-based. There's a great reason for it. But again, we have to get out of the emotion of it, the fear, the uncertainty, the doubt, break it down. Do what we're doing. Be an armchair economist. Look at what's going on. And actually, I have a lot more confidence in the decisions that I'm making around real estate when I pay attention and get out of the emotion of it. Because as you know, I can get pretty fired up politically. It pisses me off. But ultimately, let's just get back to the data.
Well, Patrick, that was an action-packed episode. We talked China. We talked the bond yields. We talked money supply. I love how we got deep into money supply. What a great show. Episode 50 done. Now we're looking forward to episode 51.
If you enjoyed this episode and you want to hear more of what JG and I have got, check out our last episode. It was epic.